Welcome to the part 3 of the interest rate and bond valuation. In this session, we are going to understand the key inputs and basic model used in the valuation process. We're going to apply the basic valuation model to bonds and describe the impact of required return and time to maturity on bond values. We're going to also look at yield to maturity, its calculation, and the procedure used to value bonds that pay interest semi-annual. So, valuation. So valuation is the process that links risk and return to determine the worth of an asset. There are three key inputs to the valuation process: cash flow, timing, and a measure of risk. So cash flows are something that we will receive or we will pay, timing, when they are received, when they are paid, and measure of risk, who issued the bond, what is their risk level, and what is their status of default. Especially when we talk about measure of risk, is the risk of default is the primary concern. A basic valuation model, we also called it discounted cash flow model. So discounted cash flow model, and it is applied in a number of ways. So the model is normally represented by the value of an asset. It begins at V naught equals to, then we have cash flows, which is first cash flow, and it is discounted by 1 plus R1. If you remember, this is the same part that we used to do to calculate present value of any cash flow. So present value formula, if you remember, it was present value equals to future value divided by 1 plus Rn. Now if n is equal to 1 is for the first year, n is equal to 2 is for the second year. So with the same context in mind, we have for second cash flow 1 plus R2, and then we have, so we can go move on and we can construct the nth cash flow 1 plus Rn. Now this is the base model where cash flows are the expected at the end of the year. T is equal to 1, 2, 3. Then we have the R, which is the appropriate required return, and then we have the N, the relevant time period, so which is 5 years, 10 years, whatever the number of years involved in the valuation. And when we do this discounting for each cash flow, so normally each cash flow is discounted 1, 2, 3, whatever, and all are added. So we get the value V naught, which is the value of the asset at time 0. So if I have to draw a little timeline, you can also look this from this. So it is 0, 1, 2, 3, and you can see that the first cash flow is brought to 0, the second cash flow is brought to 0, the third cash flow is brought to 0, and so all of them are added and we get the V naught. Now let's look at an example of this discounted cash flow model. Celia Sargent wishes to estimate the value of 3 assets she's considering investing in. And this is something that will come across your professional life as well as personal life almost always, that you have different options and which one to choose. However, in this question, we are only looking at discounting cash flows rather than making a decision. So stocks in Michael Enterprise expect to receive dividends of $300 per year indefinitely. Whenever the term indefinitely or forever comes, this means that it's a perpetuity question. And this means that we have, the formula would be the V naught equals to the dividend or whatever the cash flow. Let me write the cash flow divided by R. Then we have oil well, the second alternative, which is oil well expects to receive cash flows of 2,000 at the end of first year, then 4,000 at the end of second year, and 10,000 at the end of fourth year when the well is to be sold. So these are the different cash flows on the timeline, and we have to discount all these cash flows using the discounted cash flow model. The third option is the original painting. This is a firm expects to be able to sell the painting in 5 years for $85,000. If you look at it, this is a single amount question. Single amount questions means that you have to bring back the 85,000. So you can use it future value divided by 1 plus r n, where n is equal to 5 years. Future value will be 85,000. And what is the r? The r is not given in either of the questions. So Celia has to find the r for each because every alternative has a different cost. So we look at here in the first case, she's have CF WAF divided by R, where we have $300 divided by 12%. This is the 12% is the cost that has been used here, and this comes out to be the $2,500 if she invests. Now, if she invests in the oil well, she will get the first cash flow 2,000 for R is the, and 2,000 is the cash flow. The second one is the, and this is the third one. R stays the same while we have the first year, second year, and the fourth year. So it's the fourth year in which she will receive this. In the third year, there is nothing. If you discount all of these and add them together, you will get $9,266.988. Now finally, Celia estimates the value of the painting by discounting the expected 85,000 in 5 years, which I already told you that it will be the future value divided by 1 plus r, and where we have 85,000 divided by 1 plus 0.15, and then n is equal to 5, comes out to be $42,260. So discounted cash flow is very important, and there are different forms. One is perpetuity, the other is the series discounting, and the final one is the single payment discounting. So drawing on the discounted cash flow model, we can develop the basic bond valuation model as well. Only the terms will change, and otherwise it will remain the same. So we can see that, here we can see B naught is represented representing the bond value. Before we were using V naught. So let me write the bond valuation formula in terms of discounted cash flow formula. So that will be V naught equals to the first cash flow. Then we have the 1 plus R N. Then we have another CF2 1 plus R. Sorry, it has to be 1. Then this is 2. And then we have CF3 CFN 1 plus R N. Now converting this into a bond formula is much easier. First, in bonds, we have same cash flows. So CF1 equals to CF2, same for all cash flows because they represent coupon payments. And coupon payments are calculated as the stated interest rate, or R, multiplied by the face value of the bond. So if the interest rate is 2% and the face value is $1,000 bond, then we will have the $20 coupon payment. Now this $20 will remain the same until the maturity. So whatever, if it's 5 years, every year the bond pays $20, it will remain $20. So we do not have to mark the same formula for discounted cash flow with separate cash flows. We can say that it is, so transforming this formula a little bit to visibly show the bond formula, this B naught equals to, then we have the cash flow, and that is CF 1 plus R, CF 1 plus R 2 plus, and it's the same cash flow goes. So we have CF 1 plus R N. Apart from that, so the cash flow is the coupon payment. However, the bond also pay back the principal amount. For that principal amount, we have to bring the principal amount over 1 plus R N separately. Technically, we put this N for both because the last interest payment or coupon payment comes together as a package with the principal, or the face value, principal payment. So these are bunched together. Now, in the other way to express the same formula is B naught equals to I sum of plus M into, and I'm bringing this formula here because I don't have a space. It will be 1 over 1 plus R d n. Now this is because cash flow is same, so we can bring the similar terms together. And what these terms means, you can see that the I is the coupon payment. So it is basically the coupon payment, which is called annual interest rate paid in dollars. This is exactly the definition of coupon payment. Then we have N is the number of years, M is the par value, which is the principal value in dollars. Then RD is the required return. This is given here, and you can see that RD is the required return or yield to maturity. So we use two terms here, and you have to remember this is the RD is yield to maturity of the bond. We also call it the internal rate of return, as I said earlier, and also this is called required return on a bond. Now, coupon payments interest is different than the required return. Please remember that coupon payment interest rate is different. This R is different than the RD. RD is the required return on debt, while R is simple interest rate, which is used to calculate the coupon payment on the bond. Now let's look at the valuation. We have Mills Company, a large defense contractor, on January 1, 2016 issued a 10% coupon interest rate, 10 years bond. So this is the N with 1,000 par value that pays interest annually. Now please remember, we are saying pays interest annually. We will in future convert it to semi-annual as well. We'll study how to calculate that. Now investors who buy this bond receive the contractual right to two cash flows. The first is $100 annual interest rate, that is 10% coupon interest rate. So you can see that if it's $1,000 par value multiplied by the coupon interest rate, which is given here, and you multiply it, you will get the coupon payment, which is $100. This is the coupon payment. Now at the end of the each year, so it's the end of the each year problem. Now remember, since CP or coupon payment is same for every year, so this becomes an annuity problem. And because it's ending, it becomes an ordinary annuity problem. So you have to look for these terms in order to figure out which one this is. The $1,000 par value at the end of the 10th year. So you will also receive another cash flow, the final cash flow, the original investment of $1,000 returned to you at the end of the 10th year. Now, if assume that the interest on the Mills Company bond issue is paid annually and the required return is equal to the bond's coupon interest rate, so this is also another, that R equals to RD, which is required return is equal to the bond's coupon interest rate. Now, coupon interest rate is 10%. So we assume that it is also the RD. Now, what is the bond value? You can see in this timeline that from 14 we starts and we all the way goes to 2023. In 2023, we have two simultaneous cash flows. The last coupon payment as well as the face value or principal or the principal payment. Now, it's an annuity problem because all the interest payment or coupon payments are same for all the years. However, we have the formula and we can use that formula. But here on timeline, you can see we have to discount each one of them to the point 0, and we will get this, add them together. This will all add to $614, while the last payment, which is $1,000, will be present value of it will come out to be 385.54, and the total will become $1,000. Why it is $1,000 present value with all these cash flows is because we have R equals to RD, which means the required return equals to the interest payment that is paid on the coupon. We can use the calculator to do the same, and it's the same function that we used in time value of money. So it's the TVM functions. You have to put N is equal to 10 years, I is equal to 10%, which is 10, PMT, which is annuity. This is used for annuity. And this is $100 future value. When you add, you have to put 1000, enter 1000 as future value, compute present value, you will get this one, minus 1000. It's only because 10% interest rate, I, equals to the payment, which is also based on the 10%. So these are two same, which allows you to have the same present value of 1000. Similar, you can do the calculation, you can use the formula and you can calculate it. Now, so in bond valuation, we are going to look at bond value behavior. Now, from the previous formula, you would know that the bond value is inversely proportional to the RD, the cost. So if RD increases, the bond value will fall. If RD decreases, the bond value will increase. This inverse relation is universal for bond valuation, and it's always inversely proportional. So let's look at the other things. For instance, bonds in the marketplace are rarely equal to its par value. So whenever the required return on a bond differs from the bond's coupon interest rate, the bond value will differ from its par value. So it's like the value after issuance will no more be $1,000. It will fluctuate over, above, or above the $1,000 or below the $1,000. So if $1,000 is the par value, then we have, and the bond goes above 1,000, let's say $1,100. So we have a premium bond. And if it goes below 1,000, like 800, so it's a discount bond. The required return is also likely to differ from the coupon interest rate because economic conditions have changed, causing a shift in the basic cost of long-term funds, and the firm's risk has changed. If you remember, the nominal interest rate is equal to the risk in, so you have a real interest rate plus inflation and plus the risk premium. So we have basically the real interest rate is, so I'll mark it with the R, real interest rate plus the inflation plus the risk premium. And you can see the risk premium is will affect the nominal interest rate plus the R, the real interest rate, because of the economic conditions. They can change. When the R in the market changes, obviously it will have an effect on the bond's cost, that whether bond is costly or it's worth investment. So this is going to change the price of the bond. So increases in the cost of long-term funds will raise the required return, and decreases in the cost of funds will lower the required return. So let's look at the bond value behavior. We take the same example where Mills Company bonds rose to 12% or fell to 8%. These are the two scenarios that we have to look at, and the rest of the information is same. For instance, 10% coupon interest rate, 10 years maturity with a $1,000 bond par value. Now let's look at it. When it's at par 10%, the required return RD equals to the interest rate on the bond. Then we have the bond price will be $1,000 and it is said that it's traded at par value. That's the nomenclature. If 10% or RD is greater than the interest rate offered on the bond, then we have the bond which value will be lower than the 1000 and it's said to be traded on discount. Then we have the third one where third scenario where the required return is less than the interest rate uh, on the bond, and this will lead to a higher price, and it is said that the bond is traded at premium. Now let's look at dynamics of this whole scenarios, all the three scenarios. So let's identify a few variables. So IB is for interest rate or coupon rate on, so it's the coupon rate on bond. And then we have IM, which is the market interest rate. And then we have uh, the RD, which is the required rate of return. Now, the first scenario is the par value, where we have IB bond equals to IM, the market. So if the interest rate is same for the interest rate of the market equals to the coupon payment or coupon rate of the bond, then what happens, the expectations are that the bond will pay the same rate. So RD is equals to IB, and this will leads to, since they are same and the difference, there is no difference, so we will have the bond price will equals to the par value, which is $1,000. Now in the second case, if the bond offers interest rate which is higher than the market, this will lead to RD. So this is, investors will expect higher return since bond is offering higher coupon payment over and above what market is offering. Then they will expect high required return, which means that it will be greater than the coupon payment or coupon rate. This will lead to the bond value of uh, 887. But this is what I want you to understand, that RD and IB has a difference, and this difference is positive. Now what market does, that this difference will be incorporated in the valuation in a way that when 887 increases to the $1,000, which is paid at maturity at a higher speed, because the rate is high, the required return is higher than the coupon rate, hence it will be quickly reached to 1000. Another interpretation could be that 1000 is discounted back to 887 to absorb the positive difference that has been created between the RD and IB. Now the third is, if IB is less than the interest rate in the market, so bond is offering lower interest rate than the market. In this case, the RD will be less than IB. So because the expectations are that bond is offering less than the market, hence the required return will also be less than the interest rate. So this difference is negative. Now in order to absorb this negative difference, the B naught will be offered at a premium, which is 1134.20. In one explanation is that this negative difference, it's a negative difference, will be priced as a higher than the par value, and over the period of time it will come down, it will reduce to $1,000 at maturity. So the negative reduces the price and brings it back to 1000, while positive difference increases it back to 1000. So when the interest rates are lower, when this condition exists, it's a premium bond. When this condition exists, it's a discount bond. The same we can calculate through calculator, and you can do it on your own. You can see that it's, again, you have to remember that these are the annuity questions, so we use the payment function. Also, when the interest rate is different than the interest rate used to calculate the coupon payment, then you will have a different solution. It's not same. But if it was 10%, it was calculated, if it was 10%, then you would have the same par value calculation, which is 1000. Similarly, this bonds can be calculated using the formula, or you can structure it all by yourself without using any formula. This is also shown, the relationship between bond values, the B naught, and the required RD. This relationship is also shown here in the graph, and you can see it's an inverse relationship. It's an inverse relationship, and if it was issued on par, you can see this is a par value, 10% for $1,000. But if the bond, the interest rate RD, or the required return, falls to 8%, the the bond becomes premium, and it is priced at a higher value. When the RD increases to 12%, the price will fall to 887. This inverse relationship is very important. The curvature of the curve is very important, which is in the more advanced levels. You'll see that we have to calculate the duration and convexity, which are the risk measures of bonds, and they depend on the curvature of these curves. So interest rate risk is the chance that interest rate will change, thereby change the required return bond value. So this is one of the risks that bond faces. Rising rates, which results in decreasing bond values, are of greatest concern. So the shorter the amount of time until a bond's maturity, the less responsive is the market value to a given change in the required return. You can see from here time to maturity, how does it affects the required return of a bond. If you take the yellow, the premium bond, so it starts falling as we go. At maturity, all of them comes to 1000, the principal amount that has to be paid. So all of them will eventually converge to 1000. Now before 1000, the bond value will be slowly moving towards, in a curve, towards the M. And here it's moving, the discount will be, a bond will increase in value, as we have discussed already. So it will increase, and the difference, the speed of increase, or the difference between 1887 is because the RD is greater than the uh, coupon rate, which is IB. And here it's the reverse, which is RD is less than IB. And here we have the required return, RD is equal to IB. These are the different scenarios that we already discussed. The yield to maturity is the rate of return that investors earn if they buy a bond at a specific price and hold it until maturity. This is what we call the RD in the formula. So basically, we already know that B naught is inversely related to the RD, and if RD increases, the value falls, and if RD falls, the value of the bond increases. Now, if the yield to maturity in a bond with a current price equal to its par value, so we can say that if the bond value equals to par value, then it means that the uh, yield to maturity equals the current interest payment or coupon payment of the bond. Now, and when the bond value differs from the par, the yield to maturity will differ from the coupon interest rate, which we have already covered. Let's look at this quick example. The Mills Company bond, which currently sells for 1080, has a 10% coupon interest rate and a $1,000 par value, pays interest annually, and has 10 years to maturity. What is the YTM, bonds YTM? Now YTM is calculated as the interest rate. So this is what we will call YTM. You can see that the input functions are present value, we enter as 1080, PMT, which is annuity 1000, N is 10 years, and then we have the future value, which is 1000. This is the principal amount that we will receive at the end, at the maturity. Compute I, this I will be the YTM, and it will be giving us 8.766 solution. Please remember to clear the calculators always or reset them so that the previous values does not interfere with the current calculations. You can do it same manually by calculating the IRR. As I said, you can use the RD, which is called YTM. It is also called IRR, internal rate of return. And when we go to capital budgeting and we'll be using internal rate of return, you will see that IRR actually is the same as calculating YTM. And the whole concept, all the formulas are the same. Now, you can also use a formula like you can calculate the rate because the rate is the unknown that we need to find out, and you can calculate it by this formula as well. So if the bond pays semi-annual interest rate, normally in US all the bonds pay semi-annual interest. So in order to incorporate that characteristics or that issue, we can use the following procedure. We can convert annual interest rate I to semi-annual by dividing it to 2, converting the number of years to maturity N to the number of 6 months period to maturity by multiplying N by 2. So basically we divide by 2 the interest rate and we multiply by 2 the time period. So converting the required stated annual return for similar risk bonds that also pay semi-annual interest from an annual rate to a semi-annual rate by dividing RD by 2. So these changes allows us to calculate semi-annual interest rate. In fact, if you look at it, the number of the time period, so if it's 1 year, if we are paying semi-annual, it becomes 2 time periods, 2 semi-annuals. So we have 0 to 1, and now we have 2 time periods, so we have N doubles. N is doubled. Secondly, if it was quarterly, we would multiply by 4. However, those are not part of the conversation right now. And similarly, the interest rate, which was annual, RD, or the cost of interest rate, as well as interest payment, I, they are for the annual. Now we have to divide them by 2 to make them semi-annual. So we calculate for each time periods independently. Now let's look at the example where we have assuming that the company Mills Company bonds pays interest semi-annually, and that the required interest rate is stated annual return RD 12% for similar risk bond that also pays semi-annual interest rates. Now if we substitute these values into the previous yield, we will have the following. Let me write it. So it will be B naught equals to $100 divided by 2. So now we divided by 2 the interest payment, and we will multiply by T is equal to 1 to 20. So it's a 10 years. Now we have 10 multiplied by 2. So basically N multiplied by 2 is 20 time periods. 20 semi-annual time periods. So it's now semi-annual. And that would include 1 over the 1 plus 0.12 divided by 2, and then we have the T, and we will add this to M, which is 1000 maturity value, and then we have the last interest payment also, which is 1 over 1 plus 0.12 over 2, and this we the last payment is on 20th, so that would we add, and this will gives us the value of 885.30. Now this semi-annual means uh, so this divides everything by 2 while multiply by the time periods by 2. You can see the same here. Right now we have to manually figure out this. So n is, instead of 10 it becomes 20, so we multiply n by 2. I becomes 6%. This is 12%, so now it is 6%. We divide it by 2, so not this one, but basically we divide 12% divided by 2, which comes out to be 6%. Payment also uses, so it was $100, we divide by 2, and so we input all these values, we get minus 88.530. Similar calculation can be done by using the formula here, but you have to manually change the values according to the duration or the time periods that are used in the question. So let's review the learning goals. We in this session we have covered the basic model used for valuation process, which is discounted cash flow model. Next, we have also looked at the required returns and time to maturity on bond values. We have looked at the conditions for the par value bond, the discount and the premium bonds, and saw a bit of a structure behind them. Also, we have explained the yield to maturity, that this yield to maturity, what it is, its calculation and procedure used to value bonds that pay interest semi-annually. So we only cover semi-annually, although a similar procedure can be used to calculate quarterly, or the frequency can be changed as per the requirements. However, we stay connected to only semi-annual interest payments. For now, thank you.